Alrighty, well, I think we'll get going. So I appreciate everyone taking the time to attend the webinar today. I'm really excited to share this piece of legislation, which is really important in hopefully assisting the Australian economy continue to grow into the future. Please do not hesitate to jump in with questions at any time. You can do so by just typing in the question and answer tab on your screen, and I'll either address it at that time or hold it over to the end of the presentation where appropriate. So a quick summary of today's presentation, and a great place to start is by giving you a rundown of what exactly the Safe Harbour protection is. The Safe Harbour Bill provides relief for directors from insolvent trading claims for debts incurred with the aim of restructuring a company. This will help address the perception that the Australian insolvency laws are some of the harshest around the world, and which actually drive directors to seek personal protection over that of the company's interests. Directors can be pursued personally for debts incurred during a period that it's proved that the company traded whilst insolvent, if that company is placed in a liquidation at a later date. The aim of providing relief for directors is to encourage them to remain in control of the process, that is, have an active rather than passive role in the restructure, as opposed to appointing an external administrator to undertake this restructure. This will mean that they can leverage their inherent knowledge of the company's business to hopefully achieve a better outcome than an external administration. Protection is available to those directors who act in good faith with due diligence and care in a genuine attempt to restructure a company. It is hoped that the relief will discourage directors from focusing on their personal exposure through insolvent trading claims during times of financial distress and redirect their energy into exploring viable restructuring options. We've actually seen a decline in voluntary administrations in the SME market, and a bit of a flow-on to an increase in liquidations with a significant shortfall in assets. This is arguably attributable to the erosion of value that often follows a VA through the termination of critical contracts combined with substantial professional fees. What Safe Harbour does is provide a cost-effective alternative for a company's director to restructure the company. And we actually had a really relevant case study just 3 months prior to this legislation coming into effect in September last year. We had the company Surf Stitch Limited, where directors resolved to place the company into voluntary administration. Not all directors voted in favour of appointing a VA, as they weren't convinced that the company was insolvent and that there may be other options available. However, these dissenting directors were outvoted, as the overwhelming majority were of the opinion that the company were insolvent and they needed to protect themselves against any potential insolvent trading claim. What has eventuated subsequent to that appointment is that an agreement has been struck with creditors where they would all receive 100 cents in the dollar for their debt, and the company's equity has been restructured to allow the company to move forward. Now, given that all the debts have been discharged in this case, and if Safe Harbour had been effective at the time, the directors could have protected themselves from insolvent trading, whilst taking more time to assess the financial position of the company and other restructuring options, and therefore the restructure may have been able to be completed without the statutory tasks and the significant associated costs required in a voluntary administration. Just a quick refresher on insolvent trading. Now, a company is insolvent when they are unable to pay all of their debts as and when they fall due. There's two tests to solvency, the primary one being the cash flow tests, and that being the liquid assets available for a company to pay its current liabilities. And then on the other hand, we have the balance sheet test, which looks at the net asset deficiency of a company to determine whether it is in fact insolvent. And I guess some indicators of insolvency for you as advisors to keep an eye out for. and proactively work towards avoiding these things. Things like a history of continuing trading losses, cash flow difficulties, the company is experiencing difficulties in selling its stock or collecting its debts. Creditors are being paid outside usual terms or demanding that they receive cash on delivery. The company is not paying its Commonwealth or state taxes. Being in this game long enough, we know that it's usually superannuation and GST and PAYG that are the first things that are deferred when the company is experiencing cash flow issues. You may have legal action being threatened against the company. A really critical one is if they have a funding facility with a bank, the company has actually reached the limits of this funding facility and they are unable to increase that limit or refinance in another way. And even something as simple as the business premises looking tired and disorganised can be an indicator of insolvency and something to keep an eye out for when you're dealing with your clients. So it's useful to look at what is a genuine restructuring plan. I see this as having two limbs. The first being that the plan should achieve a better outcome for creditors. And this is made by comparing the outcome of the plan with what the picture would look like if an external administration commenced immediately. The better outcome also needs to be reasonably likely. Now, this does not require the plan to have a better than 50% chance of eventuating. What the term reasonably likely represents is that the plan has a chance of achieving a better outcome that is fair, sufficient, or worth noting, and it shouldn't be fanciful or remote. So obviously that requires a level of judgment, but that is the general parameters that a better outcome and a restructuring plan should be focused on. Legislators have recognised that directors will often be making decisions about a turnaround and its likelihood of success in real time, under pressure and with imperfect information. And this is where the terminology of reasonably likely comes into play, that they're never going to have absolute certainty about a plan, but as long as it remains reasonably likely, protection under Safe Harbour will exist. And finally, so protection for directors commences as soon as they start considering a restructuring plan. However, they do need to move from the development phase into the implementation phase within a reasonable amount of time. Otherwise, that protection ceases to exist. And it would be generally expected that the restructuring plan should have some kind of quantitative analysis of what the outcome is going to look like for creditors in the restructuring plan versus what creditors are likely to achieve in an external administration. And some factors that would go into this type of analysis would be issues like whether the business is forced to wind down or whether it can go through an orderly wind down process or in fact achieve a sale as a going concern, the certainty and time period for improved results to creditors, the market and industry conditions, the level of debt owed by the company, and whether that debt is owed to unsecured, secured or related parties, and how likely it is that these debts can be compromised, forgiven or deferred. Crucially or critically, whether new funding can be obtained to fund the turnaround plan. And then there's an overarching guiding principle, whether it's in fact in the public interest for this turnaround plan to proceed. The second limb of what entails a genuine restructuring plan is that the plan should be reviewed or collated or considered by an appropriately qualified advisor. The bill has been drafted to provide some flexibility as to who qualifies as an advisor. The minimum requirements of the advisor are that they should have suitable professional indemnity cover to cover the advice that's going to be provided. They should be in possession of the minimum educational requirements, and that includes ongoing training. to give this kind of advice, and they must be bound by a professional code of conduct. Now, why this is relevant for advisors in the SME market is that the explanatory memorandum to this piece of legislation actually, and I'm quoting here, notes that a small business may only need to seek the advice of an accountant, lawyer or other professional. And this can be contrasted with a large listed entity which might retain an entire team of turnaround specialists and insolvency practitioners to advise on their restructure. So this is crucial as advisors in the SME space. I guess some of the roles that an advisor can play in this process, I think off the top, you'll be looking to engage an advisor to do some kind of financial analysis and solvency assessment of the company. And this will tick the first box to see whether the company actually does need to look at seeking protection from any insolvent trading claims moving forward. And then the company needs to look at, well, what kind of restructure are they going to undertake? If it's looking at restructuring their debt, some of the roles that advisors can play would be negotiation with creditors, negotiating on debt waivers, compromise and deeds of forbearance. You'd be looking at liaising with the secured creditor, either to refinance or put in a reporting regime to ensure that they're kept the price of the turnaround plan at all phases. You may need to engage a cross-border insolvency expert if you're dealing with suppliers internationally, and even looking at getting in the right legal expertise to guide you through a debt restructure. If the company is looking more at a strategic restructure or turnaround, there would be a chance to have an experienced businessman join the board of directors, and the protection of Safe Harbour will make it less risky for these type of people to join the board and able to share their knowledge and their experience without exposing themselves to personal exposure through a potential insolvent trading claim. If the company was looking at some kind of operational turnaround, they may well be looking at installing an experienced turnaround manager to sit within the business and guide that process. They may be looking at engaging an industry or field expert. An example of this may well be a specialist engineer that may be brought in to improve a manufacturing plant's processes and systems to increase efficiency. And that would qualify as an appropriately qualified advisor. And then finally, if you're looking to improve the corporate governance of the company, again, you'd be seeking advice of people who have been there and done that before, and this protection allows that to happen. And then, of course, there's an outcome from the restructuring plan. And at this point in time, the company needs to decide whether they will exit the Safe Harbour protection and carry on as business as usual. Or alternatively, the plan is not going to be successful and they need to make a swift transition into an external administration to eliminate any exposure to insolvent trading claims in that time period in the transition. And certainly an insolvency practitioner would be best placed to make that assessment on what needs to happen in the next step. There's a number of eligibility criteria that the company has to meet in order to seek protection. The primary of those being the director continuing to comply with their obligations under the Corporations Act. These kind of things are to do with acting with due care and diligence, acting in the best interests of the company. And in fact, when the company is insolvent, it's actually the creditor's interests which are primary there, as they are the ones that are actually funding the company at that point in time. They have a duty to not make use of information they receive in their position to use for personal gain, and obviously have a duty not to act in a fraudulent manner. Any breaches of those duties will void the protection of Safe Harbour. They need to ensure that there's no employee misconduct. They need to ensure that their employee entitlements are paid as and when they fall due. As noted earlier, superannuation is one of the first debts to fall into arrears. if this does fall into arrears and it's a material breach of compliance, this will void protection. Tax reporting and payments have to be up to date. And so breaches of this condition will lead to a void into the protection. A breach would be either two events of non-compliance within 12 months prior to the date in question, or a material breach of this criteria. Then finally, accurate financial records are to be maintained. A core principle of the Safe Harbour protection is that the director at all times is making ongoing assessments of the company's financial position and whether it is still likely that the company, the turnaround plan is going to result in a better outcome for creditors. Without accurate financial records, these decisions are impossible to make and again would void such protection. It's also critical that records are maintained that if the plan is ultimately unsuccessful and a liquidator is appointed, a director must present any evidence associated with seeking protection upon appointment. Otherwise, this evidence is not admissible when defending whether the protection was sought validly. So this is really important that advisors to directors that are on the verge of appointing an external administrator, that they have their ducks in a row and have their records in order to supply with the liquidator upon appointment to protect themselves. And the bill has been drafted in a way that means any personal liability that is attached to the director is actually carved out if the costs occurred in relation to the restructure. So you can see the calculation up on your screen now. The potential insolvent trading claim equals $100,000, and this represents the level of debt incurred in the period while it was proved that the company was insolvent. 90,000 of that 100,000 was incurred in relation to the restructure, and that meant at this point the net insolvent trading claim is $10,000. The benefit of this being a carve-out rather than a defence is that with the defence, the director would remain liable for all the debts incurred while the company was insolvent unless they can establish a defence. On the other hand, the carve-out absolves the director of the liability for debts incurred in the restructure unless a liquidator can prove that the requirements of Safe Harbour are not met. This means that a liquidator must consider the protection and whether it is valid prior to initiating an action for insolvent trading, as opposed to historically where a liquidator could make a claim for insolvent trading and it would be incumbent on the director to establish a defence. It's hoped that this will lead to a change in the mindset of directors from one of a negative position where they will be looking to avoid incurring debt and further strangle the company and its inherent value to protect themselves from insolvent trading, to a more positive mindset where they can incur a debt with confidence that it will be carved out again in any claim against them if the turnaround plan is ultimately unsuccessful. Debts incurred directly or indirectly with the restructuring effort are eligible to be carved out. This means that debts incurred in good faith and in the ordinary course of business can be captured in the carve-out, and directors do not need to scrutinise every debt incurred. Rather, they need to take ongoing assessments as to whether the plan is still reasonably likely to result in a better outcome for creditors. And as you can see up on the screen with the calculation, what this does is even if there is some residual debt incurred outside of the Safe Harbour protection, it reduces what was a potentially commercially pursuable claim of $100,000 down to $10,000, which would be incredibly difficult for a liquidator to justify pursuing this given the costs involved and the chance of success in pursuing the claim. It's useful to look at a bit of an advisor checklist, given that there will be situations where you as accountants and advisors will only be in a position to advise your clients. Looking at the different phases, you'd be looking at pre-engagement. The engagement letter should be drafted, and ideally you'd have some kind of pro forma engagement letter which really explicitly details the scope of the engagement and what is expected of the advisor, so there can be no confusion about what's expected from the engagement. Staff training and internal checklists are critical to creating some leverage in these kind of engagements. Dealing in the SME market, you will be dealing with clients who are cash poor and really minimal funds to try and extricate themselves from a difficult situation. If you can allow some of the tasks to be completed, even though they might be quite complex, to be completed by more junior staff, that will certainly achieve a more profitable engagement for the advisor. And finally, professional indemnity should be checked and confirmed that it is adequate to provide the advice being given in the engagement letter. Upon commencement of the engagement, the logic and justification for the better outcome assessment should be documented. And this comes back to earlier where I listed some of the factors that would fall into this analysis, and there'll be some kind of quantitative analysis around the position of the creditors under the restructuring plan versus the position of the creditors in an external administration. Conflict protocol should be adhered to. In an insolvency practitioner's case, depending on the circumstances, but it may well be difficult for them to take on the external administration if they have guided the company through an ultimately unsuccessful turnaround, as that may lead to a conflict of interest through a self-review threat when the liquidator comes to assessing the insolvency of the company and whether safe harbour is valid. And record-keeping procedures should be documented and adhered to. Again, coming back to my previous slides, record-keeping forms a basis of this process, as your protection comes with those records and providing them to a liquidator if the turnaround plan is unsuccessful. Then in terms of ongoing during the engagement, monitoring the progress, adhering to key reporting dates and measuring the agreed to KPIs during the engagement are critical. There should always be a second partner review to avoid being the lead partner being blinded by their emotional attachment to the file, which can happen if you're dealing with clients through a difficult period. There should be a separation of advice, the advice being given by the advisor and the decision-making of the company. And I've actually got a question that's relevant to this point here, which asks, what are the consequences for our clients if the restructure plan is ultimately fails? And is there any liability placed on you as advisors? No, there isn't any consequences if the plan fails, because the protection is there as long as the criteria is met and the director and the advisor's obligations are met with. The protection is still available even if the plan is ultimately unsuccessful. I think the key piece there for whether there is any liability placed on advisors is ensuring that there is the separation between the advice being given and the decisions being made by the company or the director. This separation will ensure that there is no allegation down the track by a liquidator that the advisor or even an internal chief financial officer or finance manager can be accused of being a shadow director and again exposing them to any kind of insolvent trading claim. Thanks for that question. And then finally, ongoing during the appointment, it's really important to understand the triggers to engage other experts. An example of that may be the plan is looking like it's not going to be reasonably likely to achieve a better outcome. Engaging that insolvency practitioner to guide you through that swift transition into an insolvency appointment. And then finally, the outcome, a decision needs to be made at some point, again, whether the company exits Safe Harbour and carries on business as usual or an insolvency appointment is made. It's useful to have a look at the safe harbour regime from a creditor's point of view, because it does change the landscape quite a bit, and it's really important that creditors and their advisors bring themselves up to speed with the entrepreneurial nature of the law change. Some of the tools that we suggest to our clients in terms of protecting themselves would be to utilise the personal property security register to register their security interests, whether that be the advancement of funds to the company or the supply of stock or intellectual property to the company. Using the future ability to access information on tax defaults. There's draft legislation at the moment which, if passed, would allow the ATO to disclose companies with debts over $10,000 that is aged more than 90 days and haven't effectively engaged with the ATO. This would certainly be used or useful if a company is betraying to be seeking the safe harbour protection, but they are in breach of their tax duties. That protection will be void, and you'd be very careful about how you dealt with that company. You can always consider stricter terms of trade, and this includes only accepting or requesting upfront payments for services or supply of goods. Safe harbour does not prevent creditors from taking enforcement action, such as serving of statutory demands or the making of winding up applications. And of course, they can access information on the company's credit history. A small side note on this is that, unfortunately, Australia has some of the highest costs in the world to access information on corporations, which is more than double the global average. Some have suggested that as a trade-off for the more entrepreneurial laws, ideas such as lower fees to access company information and ideas such as the unique director identification numbers, which would increase transparency as a bit of a trade-off for the protection that companies get under Safe Harbour. Safe Harbour does not need to be disclosed, with the exception of large disclosing entities, and only then in really specific situations. ASIC have actually released a paper on this, and it doesn't need to be disclosed at all times for publicly listed companies. It is required to be disclosed if a company is forced to defend a winding up application. But you may well find that companies will voluntarily disclose they are seeking the protection during negotiation with creditors on deeds of forbearance or standstill agreements. And the final point I have here is current legislation doesn't provide protection or priority to new funding advance to the company or credit provided by suppliers as part of a turnaround plan if the plan is ultimately unsuccessful and a liquidator is appointed. What this means is funders should protect themselves by registering their security interests on the PPSR regime. However, this could get a bit tricky where there is a major financial institution involved and they have a first-ranking security interest. It's unlikely they are going to relinquish this right if requested by a third party wishing to inject funds to fund the turnaround plan. So I suggest that the possible future amendments to this bill may wish to address this issue, as it could hinder the raising of capital to fund a turnaround plan. And finally, it's critical to note that unsecured creditors actually bear the majority of the risk in a safe harbour turnaround, as employees and secured creditors enjoy protection. And therefore, it's useful for suppliers to consider, if approached about a turnaround plan, that they insist upon a dedicated line of funding during this turnaround period, or that a portion of the realisations from the sale of business or the sale of other assets be set aside for suppliers. It's hoped that companies in the past that would have had little option but to appoint a voluntary administrator to avoid exposure to insolvent trading will be able to utilise a safe harbour protection. So I've listed some candidates up on your screen right now. I guess candidates, as a broad comment, are unlikely to have a terminal cash flow issue. So a temporary liquidity problem is not an indicator of insolvency, but rather the company is likely to have balance sheet or profitability issues. This isn't to say that cash flow isn't an issue, and it is going to be an issue in most cases, but the current and forecast cash flow should at least provide for ATO obligations being brought up to date, superannuation being paid up to date, some cash set aside to pay advisors, and some funds available to fund the turnaround strategy and fund ongoing trading, even if that is a modified version of ongoing trading. So running through the candidates or some examples of candidates for Safe Harbour, you may have a contingent liability being assessed against a company. It could be claims for damages, breaches of contract, misleading conduct. The company may well receive a statutory assessment, which is unexpected and may be contested. An example of this may be a Fair Work Australia minimum wage assessment, which while the assessment is there, the company may be technically insolvent. And so the company needs time and space to work through this assessment and develop a plan around that. The company may be in the process of commercialising their IP. It may have an upcoming deadline for a term facility. It may be experiencing a decline in revenue or gross margin, which may be an indicator their offering to the market is becoming less competitive, and the company needs to hit the pause button and reassess what they're going to market to and how do they fix those issues. It may be a holding company with a subsidiary at the risk of insolvency, and holding companies can be pursued just like directors for insolvent trading under Section 588V of the Corporations Act. It may be part of a declining industry. I guess an example of this in Australia right now is the automotive manufacturing industry. So Safe Harbour may allow a company again to hit the pause button, look at how they can pivot towards a different supply chain and obtain a new revenue stream by looking at new customers and implementing a turnaround plan around that strategy. The company may also be enforced to write off a significant amount of goodwill of an investment, which may well leave them balance sheet insolvent. It's important as advisors to take the initiative to spot candidates early in an attempt to steer them away from a formal restructure process, which could be more costly and actually may not lead to a better outcome for creditors, depending on the situation. So I have 3 case studies to quickly go over today. The first one being Timber Corp Limited. This is actually a pre-legislation example, and it revolves around an action that was brought against the directors for insolvent trading. So a brief timeline of this file is that, so in November 2007, the Audit and Risk Committee, and there are parallels which can be drawn between this type of committee and the CFO or an external accountant in the SME market, come to the board and highlight the risk of a net current asset deficiency. The board at this point develops a plan which includes asset rationalisation and stakeholder engagement. Secure creditors are kept apprised on the turnaround plan at all times and maintain support at all times. Shareholder queries with respect to liquidity risks are addressed and the turnaround plan is communicated. The asset rationalisation did not play out as expected, and by April 2009, the turnaround plan had ceased being reasonably likely to result in a better outcome, and a voluntary administrator was appointed. Subsequently, the liquidators brought an action against the directors for insolvent trading, which was unsuccessful and vindicates the board's decisions to undertake the ultimately unsuccessful turnaround. Now, the reason for highlighting this file, which was pre-legislation, is that this kind of activity and behaviour has been occurring for a reasonable amount of time in large corporates. And this is because they have been able to incur the cost to engage an army of advisors to establish their turnaround plan, establish that they are meeting with the requirements of a defence to insolvent trading if the plan is ultimately unsuccessful. What the new legislation does is make it really clear as to the requirements to seek protection, and therefore bringing the protection to the SME market without the need for companies in this market to incur significant costs on getting advice around what is required to avoid personal exposure. Second case study here is a startup company with limited cash flow. We have Alex and Pierre, who have developed a successful app which quickly gains popularity. Deciding to expand their business, they form a company and appoint themselves as directors. They find out very quickly that their experience in developing apps does not translate into skills and experience in running a viable business. They cast around for options and they approach Arsene, who is an experienced company director. Through the process of negotiations, Arsene agrees to join the company as a director, and with the protection of Safe Harbour, he is not exposing himself to any kind of personal liability. Arsene at this point puts in place proper corporate governance procedures and uses his contacts to negotiate a line of credit to fund the company's expansion. Final case study, looking at a distressed business with the overall aim of the turnaround plan to achieve a sale as a going concern. We have the business struggling, renters in arrears, director has personally guaranteed this lease, and creditors are becoming increasingly frustrated and chasing payments in arrears. Although due to peak season just passing, a cash reserve has been built up, and that has allowed the company to ensure that their superannuation tax is up to date. Bank lending for the company has been secured by the director's personal home, with some equity in the home, making an insolvent trading claim possibly viable. So the director comes up with a plan to sell the business as a going concern. He engages with his external accountant, he engages with an insolvency practitioner, and he engages with a business broker to develop this plan further. The key points about the sale as a going concern sale will achieve a better value for goodwill to the extent that any remains in the business, and the fixture and fittings than if you were forced to wind the business up and sell it as piecemeal in a liquidation. It also reduces the company's exposure to lease liabilities with respect to ongoing lease payments and make good provisions if a new tenant can be secured to meet lease payments moving forward. A plan would also be developed around engagement with stakeholders. Periodic reporting would be put in place with the secured creditor to make sure they are fully apprised of the plan at all stages of the plan, and working with unsecured creditors on agreeing to deeds of forbearance or compromise or deferral, based on the premise that if a sale can be achieved, there will be ongoing business for these suppliers. Here's a look at the SME perspective on the Safe Harbour. It's important to note that the same rules apply for companies regardless of what sector they exist in. However, the difference is going to be that a director of a large listed company is unlikely to have their personal assets tied up in a company like a small business will have. It allows experienced directors, which in the past would have been reticent to join the board of smaller companies. Again, they would have been opening themselves up to personal exposure. And this is particularly important for professionals out there that take on appointments as directors of non-for-profit entities on a pro bono basis. Notwithstanding that they are not remunerated for their role, there is still a personal liability if they oversee trading whilst insolvent. Advisors have to be really careful when advising directors to ensure that they comply with their director's duty and that they don't take any action which may place their own interests ahead of the company. Things like Phoenix activity, making use of information that they have received in their position as a director for their own benefit, paying related parties first before unsecured creditors, can void this protection. SMEs facing financial difficulties tend to face cash flow. As I've noted previously, Super and GST are the first to fall into arrears. So this means that early intervention is critical to enact a turnaround plan before the arrears grows to an unmanageable level. And finally, the Safe Harbour process can be less costly than a voluntary administration, and there can be less damage to the company's value because critical contracts can't be terminated, and it allows the director to manage the company's affairs as opposed to an external administrator. Just a quick summary, recapping some of the main points of the presentation. So a genuine restructuring plan should have the creditor's interests as the primary focus. Depending on the circumstances, the company's accountant may be best placed to guide the company through Safe Harbour. However, it's critical for companies to be cognizant of the triggers to bring in the relevant expert at the right time to maintain protection for the director. Again, I am harping on about this, but it's a critical aspect. Superannuation and tax must be up to date. Just to reiterate that it is a carve-out from liability, not a defence, which means the evidential burden is on the liquidator to prove protection doesn't exist rather than the director having to prove that a defence exists. It's critical for creditors and advisors to be aware of their rights with respect to Safe Harbour. And again, the key message, early intervention is critical to the success of any turnaround plan. And that is about it. I'll leave you with a bit of a snapshot of who we are at William Buck. Certainly an opportunity here for anyone to jump in if they have any questions. More than happy if they wanted to take the discussion offline. Certainly happy to take your phone call. You'll have all my details in the previous emails that I've sent you. We'll also provide a copy of this presentation, the recording, for you to review at a later date. And we'll also look at releasing some further material on this in the coming weeks. But once again, appreciate you taking the time to come listen about this important topic, and hope to deal with you in the near future. Thank you.